Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we are entering another volatile week. Yesterday morning, opening up markets substantially lower on the back of Trump's threat over the weekend to hit Iran's power plants, which would have been a significant escalation in the war, especially given Iran's supposed retaliation of hitting oil infrastructure around the Gulf region in retaliation, only to see that reverse substantially yesterday after Trump posted that the US and Iran have made quote unquote very good and productive conversations regarding the complete and total resolution. And he instructed a 5-day postponement of all strikes against Iranian power plants and energy infrastructure. Arguably, probably one of the biggest single-day reversals that we've seen since the start of the war. The S&P 500 yesterday opening up, nearly 1.5% higher here. But probably the biggest collapse that we saw yesterday was in oil. We had Brent go from 113 at yesterday's open to around 96 during yesterday's session. We saw WTI collapse from $101 to around $90. And we also saw the backwardation of the front versus back month of Brent crude collapse from over $18 over the weekend to around $11 as of yesterday. So this was really the single biggest move, to the upside that we've seen since the beginning of the war. Now, if you look at the S&P 500, yesterday's move managed to hold this really important 650 level here on the S&P 500. We were opening up, or futures were pointing to a lower open below that 650 level, only to see that reverse right before the market opens, when he posted that on Truth Social. So the reality here is that the decline that we saw over the weekend and the subsequent rally was really all based on the back of rhetoric, meaning there wasn't really any significant actual change to anything over the weekend or even yesterday. So, from my perspective, I think the bigger concern that we still have here with the broader markets is really just the concern around higher oil prices and input prices and how that's going to affect inflation. Because even prior to the war, we already saw last week's inflation print come out significantly hotter than expected. And that was the February reading, which didn't include the impact of higher oil prices. So when you factor into higher oil prices, which we'll get on the May inflation numbers, that's going to put the Fed into a tight spot, which they have already acknowledged during the last FOMC meeting. We saw the markets pricing in only one rate cut here for 2025. I'm sorry, 2026, which was meant to be in December. At the moment, the market is starting to change the narrative on that. There's even the possibility of a rate hike at the moment here. The possibility of a rate hike in October is around a 20% probability. That was a near zero probability before the war. At the moment, the markets are pricing in no more rate hikes until 2027, the end of 2027. So the stagflationary environment that we find ourselves in is really the biggest concern that I have for investors. Higher inflation print, which we saw last week, is likely going to see a further acceleration on the next one. And at the same time, we saw the February job numbers collapse by a substantial 92,000 jobs. So this is really, putting the Fed into its worst case scenario of of slower growth while inflation continues to accelerate. And, the thing about stagflation is that most of us don't have a playbook for it. That's been the last time we had true stagflation was 1972. So even if you were investing around that time, it's been 50 years since you've had to use that playbook. And this is really where we've done a lot of digging with regards to understanding, what types of asset classes tend to outperform during this type of oil shock driven inflationary or stagflationary environment. So first and foremost, XLE. We have seen a really big move here in energy, even prior to the war. We saw it starting in 2026. Energy was the best performing asset class heading into the war. And since the war, that has only accelerated here to the upside. Just to put this into context, the 1972 oil embargo disrupted roughly 9% of the world's oil supply. The current Strait of Hormuz is stranding roughly 20% of the world's oil supply. So the current disruption in oil is more than twice the amount of what we saw during 1972, which was again the last time we saw a significant stagflationary environment driven by higher oil prices. And back in 1972, oil prices gained 300%. Right now, oil has gone up by roughly, let's just say on average 50% since the start of the war, or let's just say start of the year. Um, so we're a far cry from, where oil could potentially go given the size of the disruption. And I think at this moment, most of us, at least probably most of you are in the US, even though I'm sure many of you watching, or some of you watching are overseas. The impact that the war has had on our bottom line and our wallets at the pump at the moment is still, while we're seeing higher prices at the pump, the increase has been largely, at the moment still mitigated by the reserves that have been put out. Um, uh, Once those reserves are gone, I think we're going to see significantly larger impacts on fuel prices at the pump. If anyone has purchased an airline ticket in the last week, you've certainly noticed fuel surcharges being higher here. But my take here is that the markets are still at the moment pricing in, the Strait of Hormuz potentially be closing maybe a month or two. But the problem with that assumption is the fact that Iran really has no other leverage card because they are by all means outpowered by Israel and the US from a military perspective. They have zero defenses against anything that US and Israel can throw at it. The only thing Iran has as a bargaining chip and leverage is effectively closing out the Strait of Hormuz. And there's zero incentive for them to give that up, which is why, in my view, the idea that the Strait of Hormuz will be open in a couple of months, maybe less than that, and WTI getting back to $90, I think is an underestimation of the risk that the Strait of Hormuz gets disrupted for significantly longer than the market is pricing in right now, which means that the stagflationary environment that we could potentially be in is also being underpriced at the moment. I hope that I'm wrong. I really hope that I'm wrong, but that's my gut feeling with regards to where we are right now. So I think it's really important for investors to, at the very least, understand what the stagflation playbook looks like so that you can potentially prepare your portfolio for this. Because if your portfolio is currently stacked as a 60-40 or traditionally diversified portfolio for, whatever your retirement age is, that's not a portfolio that's going to stand relatively well against a stagflationary environment. The asset classes that tend to perform best are energy related stocks, commodities overall. So you can look at DBC, which is the commodities ETF, is definitely one that you can take a look at with regards to um, that generally will give you exposure to a broad base of ETFs, but predominantly the two commodities that perform well in a stagflationary environment are essentially gold and oil. So, from my perspective, if you're looking at oil, I think XLE or XOP are potential opportunities for that. The one thing about gold that is different this time was that heading into the crisis, gold has become one of the crowdest trades we have seen in a long time, which is why we've seen such violent corrections here, as a result of the war and over the last few weeks. Whoops, did not mean to do that over the last few weeks. And this recent sell-off here to this $400 level, I think is a much better entry point for anyone who may have missed out on some of the exposure in gold, because we have certainly seen a lot of the speculative bubble kind of get sucked out of gold over the last few days. Certainly, margin calls have been triggered in terms of gold, and now we're, I think, at around $400 is probably a much better entry point for most investors. So, commodities are definitely the highest correlation to a stagflationary environment to be considering for your portfolio. So, most of us are probably in our portfolios heavily underweight energy, but this is one of the sectors that will perform quite well in this type of market environment. The next one is really, inflation protected bonds. And this is an asset class that didn't exist in the 70s. There were no inflation protected bonds back then. So TIP is kind of the iShares Treasury and Inflation Protection Bonds ETF. That is a kind of broad-based ETF. You also have STIP, which is a short duration um, uh, um, inflation protected bond ETF. And, with regards to the allocation towards fixed income, right? So, away from, mega cap growth type stocks, which are some of the worst performing assets in a stagflationary environment. As you think about fixed income, it's really the short end of the treasury curve that tends to perform in a stagflationary environment. What that means is that you generally want to avoid, corporate debt, because corporate debt carries significantly higher credit risk. Specifically, you would want to avoid HYG, high yield corporate bonds. These are sort of, think about it like your um, riskiest borrowers that have, generally speaking, a higher interest rate on their loans. And in a stagflation or environment where we're talking about potentially raising interest rates, these are the types of companies that will suffer. So you want to stay away from high yield corporate bonds. You want to, there is generally speaking, investment grade, some of the best rated investment grade corporate bonds will likely be okay in this type of environment. They won't be the best performing assets, but they generally will be okay in this environment. But you definitely want to stay away from long duration treasury bonds. So stay away from TLT. Those are the most sensitive to a stagflationary environment. Those will not perform well in this environment. Short dated bonds will. So, whether that's the short dated protection bonds that I was showing you, or, if you look at SHY, which is 1 to 3 year treasury bonds. You also have BIL, which is 1 to 3 month T-bills ETF. These are all the types of asset classes that will generally be that will hold their value better in a stagflationary environment compared to, like I said, high yield or longer dated treasury bonds. The next thing, that you might want to consider a little bit are, value and defensive equities. So, value are, you can look at Vanguard value ETFs like VTV, which is probably one of the larger ones. Essentially, uh, sorry, my screen just froze. Give me 1 second. Hmm. There we go. I apologize. Never had this happen before. As hopefully my computer comes back here in a second. But what I was trying to say is if you look at VTV, which is kind of the Vanguard value ETF, we definitely find value and defensive equities. And defensive equities, I'm referring to, sectors like utilities, healthcare, consumer staples. Those are the types of sectors that, when you are invested in equities, those will provide better protection to the downside compared to, being invested in something like XLK or XLY, so consumer discretionary technology, or something like the Qs. That's kind of where you want to be generally thinking about positioning your portfolio in a stagflationary environment. So this is VTV, the value fund, which as you can see is declining less than, for example, QQQ or SPY. Defensive equities, value equities, and the other place that you might consider a small percentage of your portfolio are currencies, specifically currencies that are net exporters of some of these commodities that we're talking about. So gold, oil, so Canadian dollar, Australian dollar. You have currency ETFs that provide exposure to those like FXC or FXA, which is the currency shares Canadian dollar ETF, or FXA, which is the Australian dollar ETF. Or, you can have something more neutral like the Swiss franc, FXF. The neutrality of the Swiss tends to provide somewhat of a safe haven status during times of turmoil or volatility. So those are the primary asset classes that you want to be considering to be either equal weight or overweight in your portfolio. The places that you generally want to start thinking about cutting back on are, like I said, SPY, QQQ, those types of broad-based market indices or growth-based indices. Even small caps, is definitely one of those places where small caps are most sensitive to a stagflationary environment because smaller cap equities typically have lower margins. They're not able to pass on, higher input costs to the end consumer, as well as kind of these, your Coca-Colas of the world. And they generally speaking have higher rated debt, or debt at a higher interest rate. So they tend to get squeezed the first in a stagflationary market environment. You generally also want to avoid um, economies that are net importers of oil in this type of environment. So especially if you look at the European Union, Britain, these types of countries are net importers of oil, or rely almost entirely their oil supply on imports. Those are ones, especially their currencies, will tend to suffer in this type of market environment. Staying away from, like I said, longer dated treasuries, kind of your broad-based bond ETFs like BND, LQD. These are ones that you generally want to be thinking about being underweight and being more specific in the tranches of fixed income that you have, which, like I said, you want to be in treasury protected bonds and short dated treasury bonds, generally speaking, in a in a stagflationary environment. And then, your typical cyclical sectors like consumer discretionary technology, those are generally ones that you want to start thinking about reducing some exposure in. And then, like I said, the euro, Japanese yen, British pound, those are the currencies that you want to avoid because those are all net importers of oil or rely almost entirely, their oil supply as imports. So those currencies will likely suffer as oil prices rise and they have to spend an outsized amount of their GDP to essentially power their economy through, oil and natural gas. So at a very high level, that's kind of your stagflationary playbook. It's like I said, I'm really hoping that my views on Iran are wrong and that the strait opens relatively soon. We have an off ramp with Iran, and then we can kind of get back to a normal. Because since the 70s, we certainly have had at least 5 or 6 different instances where there was the risk of stagflation, but we never got into the actual we never got ourselves into a stagflationary environment. The last time we saw a stagflation scare was in 2022 when Russia invaded Ukraine. And just to put that into context, when Russia invaded Ukraine, the amount of oil that was disrupted was roughly 3% of the global supply. Right now, the Strait of Hormuz, about 20% of the world's oil passes through the Strait of Hormuz. So, we're talking about a significant different order of magnitude, that this conflict has than in previous times, right? We also had a stagflationary concern back in 2007 before the financial crisis, but we didn't have inflation to the degree that we had right now. There are a few things that are obviously very different between now and the 70s, so it's not fair to just apply everything that we saw during the 70s exactly and expect everything to play out exactly the same. For example, back then the Fed didn't have the same credibility and the tools that they have access to today, like QE, QT, reverse repo, all of those tools that the Fed now has as at its disposal to fight inflation while maintaining employment. The U.S. also is not hugely dependent on Middle East oil anymore. We're a net exporter of oil. We also have a strategic reserve that we didn't have back then. Inflation is also at the moment still relatively low, or we're starting from a relatively low base compared to where we were in the 70s. But like I said, the sheer size of the global oil market that's being at risk right now is just unprecedented. And the other thing that's very different today than it was in the 70s is just how interconnected the global economies are now versus the 70s. And the way that I think that's going to play out is the fact that the impact that stagflation had on the global economy and different asset classes during the 70s played out over months. It took almost a year and a half to really propagate, if you will, throughout the entire economy and different asset classes. I think given the interconnectedness of our global economy today and the speed at which data moves, that propagation of information and how that's going to affect the different asset classes, I think will simply happen at a much faster pace. So When we say that, certain assets will tend to perform better than others in this type of environment, I think you'll just see that performance happen over a much shorter period of time rather than propagating slowly through the economy as sort of this data comes in. So, it is not by any means a exact comparison to the 70s, but it is very similar given that the 70s stagflationary environment was triggered by significantly higher oil prices as a result of a disruption in oil supply in the Middle East. So, from that perspective, we have a near perfect analogy, but there are other differences that I think are important for investors to understand before you think about positioning your portfolio for it. So today I really wanted to try to give you a bit of that walkthrough of kind of what happened back in the 70s, right? Because most of us, like I said, weren't around for it. Most of us are not prepared for it. And even for those of us that were around, it's been 50 years since the last time this happened. Most of us don't have a playbook for it, because during the 70s, during the OPEC embargo, the S&P dropped 48%. Gold was up 100%, oil was up 300%, and inflation peaked at 12%. So, if you look at kind of where gold and oil is versus the S&P versus kind of where it was in the 70s, we're nowhere near, those types of numbers at the moment, right? And back then, that was a 9% disruption in the global supply. Now we're talking 20%. So I think the risk is real. I hope that the probability of that is relatively low, but the risk is real. And I think it's important for investors to understand what the playbook is to potentially position for it. With that, that covers what I wanted to share with you here today. I hope that this is informative and helping you better understand how to navigate this from a macro perspective. And we'll continue to update you week to week on developments of the markets and how things are evolving and whether or not this playbook is playing out the way that we sort of are planning it. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.